Hi everyone, welcome back to the individual taxation classes. This class is in continuation of the previous class, which is on retirement plan. So this is retirement plan part 2. In this particular class, we'll be discussing three topics. One is simple retirement plan for small businesses. Second, other retirement plan. And the third topic we'll be covering is the rollover and conversion of the retirement plan from one category to another category. So let's dive into for more detail. Welcome back to the US taxation class. So before we went on a break, we started retirement income including IRA, which is individual retirement account. In that we understood like traditional IRA, and within the traditional IRA, we understood deductible, non-deductible, and then we also understood about Roth IRA, right? Now there is few more kind of like retirement plans we can quickly run through, and then we jump into the two main topics, which is rollover and conversion, and then minimum requirement plan, right? Then if time allows, we'll also do some question, or do you guys want like we can do few questions before we jump into additional topics? So what do you like more? Shall we do some practice so that we all get familiarized to this topic, or shall we finish off the topic and then with rest of the time we'll do some practice? Mayank, Divya, Garima, what do you suggest?
कुछ एग्जांपल के संग समझा दीजिए सर, अच्छा रहेगा.
Okay, so let's do a practice rather than jumping into the new topics. Let me take you to some practice one. So here, if you So let's do some practice of retirement income. Let's do 5 questions first. Which of the following is not a prohibited transaction for a person? Traditional IRA. So which one out of these 4 is not prohibited? No? So you need to select wrong answer. Not prohibited. One is using it as security for loan, selling property to it, receiving unreasonable compensation for managing it. All the answer choice are prohibited transactions. Which of the following is not a prohibited transaction for a person? Traditional IRA.
Option 4.
All the answers are prohibited. Safest answer.
So like we studied the traditional IRA. If you like, if you putting the money in the traditional IRA, like we cannot keep, like we cannot hold some property or using it as a security, or if I am managing the IRA for somebody, I cannot like receiving them reasonable compensation. So it sounds good. Option D.
How about others? Sachin, Mayank, Garima. No response, guys. Are you here just for the sake of being here, or you're participating? Mayank, Sachin.
Sir, I'm confirming.
Not known. I not understand.
Okay, Shubham, do you mind help everyone understand what is the call of the question?
सर क्वेश्चन ये कह रहा है कि लाइक जो हमने पढ़ा है कि ट्रेडिशनल आईआरए जो था हमारा, ट्रेडिशनल आईआरए मींस डिडक्टिबल एंड नॉन डिडक्टिबल, तो जो उसमें हम जो नीचे ऑप्शन दिए गए हैं उसमें से क्या प्रोहिबिटेड है कि हम उसमें से कौन सी ऑप्शन को चूज नहीं कर सकते? तो ऑप्शन 4 हमें ये कह रहा है कि चार ये तीनों के तीनों ऑप्शन हमारे प्रोहिबिटेड है, मींस तीनों के तीनों ऑप्शन अलाउ नहीं है।
Sachin, you got some idea?
No, sir.
Okay, so let's look at the answer. So if you see, look at the answer, what it's saying, the publication this provided prohibited transaction is any improper use of a taxpayer traditional IRA account or annuity by the taxpayer beneficiary, or any disqualified person. Disqualified person include, or any disqualified person include the taxpayer fiduciary and the member of the taxpayer family, which is spouse, ancestor, descendant, or the spouse lenient descendant. The following are the example of prohibited transaction with the traditional IRA. So from the traditional IRA, you cannot do the borrowing money from it. You cannot sell it like a property. You cannot using that traditional IRA amount which you have contributed as a security for a loan. You should not buying the property for personal use from the IRA fund. So IRA fund is, like it's deposited as an individual retirement account, right? Against that fund, what all activities you can do and what all activities you cannot do. So the prohibited activities which you cannot do is you cannot take the loan against that IRA fund. You cannot sell a property, or you cannot purchase the property by giving the IRA notes, right? And you cannot use that as a security deposit to get any loan. And you cannot use in buying the property or personal property with the IRA fund by utilizing the IRA fund. So IRA funds cannot be utilized for these purpose. So that's what it means.
Exceptions में वो था ना, like child birth हो गया, like वो something like that, है ना sir?
So exception were like medical expenses or adoption expenses. All those things were exception. Yeah. Got it, Sachin? Mayank?
Yes, sir.
Yes, sir.
Okay, so let's try next question. On which of the following date is a traditional IRA treated as distributing its asset when it is involved in a prohibited transaction? So if you use the IRA fund for the prohibited transaction, so when it will be considered as that you have distributed the fund? On the last day of the tax year involving the prohibited transaction, on the first day of the tax year involving prohibited transaction, on the day of prohibited transaction, or on the last day of the tax year preceding the prohibited transaction. So for example, you have done a contribution period over period. Let's assume you have $50,000 in your IRA account. Now you have given that IRA account as a security deposit and taken a loan, right? So will that be considered as distribution of the IRA? If yes, then on what date? That is the core of the question.
Option first, on the last day of the tax year.
Last day? Okay. How about others? Shubham?
Sir, I think ये option third होगा, वो 10% penalty भी लगेगी sir, I think.
Yes.
Something like that.
Mayank? Garima?
Sir, I'm not able to get this one.
So call of the question is that, for example, year over year, let's assume yourself, you're a US citizen, right? And you are depositing in IRA every year $6,000, let's assume, right? Now it's being, let's say, 5 years, and you have already 30,000 deposit, right? And now you want to let's say, purchase a new Mercedes car and you need some money, but you don't have that much money. So to the Mercedes dealer, you said you can take my IRA as a security deposit and give me the car. So on which date it is being considered that you have distributed the amount, or you have, you can say, withdrawn the IRA amount?
From that point of view, I will go for the first one also.
Why
Because,
first one?
because we'll file that the last day of the tax year, like. So that's why I'm going with that one.
Okay. How about others? Garima, Vivek?
Well, I think if it's prohibited, then it's option third, and it will be a 10% penalty. And if it's unprohibited, then it's option one.
Vivek, what's your thought? Garima?
Option one.
Why? Why option one? Why option one, Vivek?
इतना सब ध्यान नहीं है पर option one ही लग रहा है.
No, it's not just bluff. There should be a reason when you are selecting any option, why you are selecting any option and why you are not selecting other option. Exam should not be bluff. You should know the reason why you're selecting some option. So why you feel like you and Sachin and Mayank has shared his reason, like he said, like tax return we are filing on last date, so hence I'm selecting first option. And Mayank has shared his view, like why third option, because if it is a prohibited transaction, it has to be on the date of prohibition, because interest and penalty will be levied accordingly. Which one I should go? Yeah, Garima, what's your view?
Sir, I will go with the third option.
Third option? Why? Why third option?
Sir, as the reason like that the Mayank said.
That's incorrect option. Let's see which one is correct. On the first day of the year involving the prohibited transaction. So the publication says the general rule of IRA account, when the owner engage in prohibited transaction, generally if the taxpayer or taxpayer beneficiary engage in a prohibited transaction in connection with the taxpayer traditional IRA account at any time during the year, account stop being an IRA on the first day of the year. So this is like exception to the general rule. Right, Mayank?
कौन सा ठीक है सर, फर्स्ट है या सेकंड?
First one.
Okay.
So we can add this point here in notes also. Yeah, as of now, we have not studied about distribution, right? But yeah, I can add this point here in the notes also. No worries, I'll add this in the notes also. So we'll get that. Cool. Next question. When must excess contribution to IRA for the year 2021 be withdrawn so that the contribution are not subject to any penalty? When must excess contribution of IRA be withdrawn? If both the excess contribution and earnings withdrawn before April 15, 2022, including extension, if both the excess contribution and earning are withdrawn before December 31st, 2022, if the excess contribution only are withdrawn before December 2022, if both excess contribution and earning are withdrawn before April 15, 2022, excluding extension. So what is the call of the question here is, when must excess contribution, that is like more than 6,000 to IRA for tax year 2021 be withdrawn so that the contribution are not subject to any penalty? First is before April or before December?
Before April.
Before April. So before April, so then your second and third option is out, right? Then you have first and fourth option. So including extension or excluding extension?
Excluding extension, option 4.
Yeah. How about others?
First, including extensions.
What is including extension?
ये तो थोड़ा मुश्किल है बताना.
No, everything cannot be bluff. So there should be a reason to it. When you are hitting any answer, it may be right by luck, it may be wrong by luck, but when you know the reason why right is right and why wrong is wrong, then I think you'll be more confident in exam. Yes, Sachin?
Like, sir, I also want to know what are extensions, sir.
Extensions are, for tax filing, there is a 6-month extension available if you are paying like all taxes before the filing date.
Okay.
Extension is extension for filing the return, basically. Yes, Sachin, Garima.
Sir, no idea, sir.
No idea. Yeah, Garima, what's your thought?
So option 4.
Okay, let's give a try. Now, the option 1, including extension. So publication 590 states in a part that if any part of the taxpayer contribution in excess of contribution for 21, it is subject to 6% excise tax. The taxpayer will not have to pay 6% tax if any 2021 excess contribution, including earning on those contributions, were withdrawn by April 15, 2022, plus any extension period. So including extension period, if you are withdrawing, then there is no additional penalty to it. So up to extension period, it's allowed. For 2021, owners of traditional individual retirement account, traditional IRA, are required to begin receiving distribution no later than the following date. For 2021, owner of traditional IRA are required to begin receiving the distribution no later than which date? By April 1st of the year following the year in which the owner reaches 72-year age, by April 1 of the year following the year in which owner reaches 59.5-year age, by January 1 of the year in which owner reaches 72, by April 1 in the year in which the owner reaches 72. Have you understood like what is the call of the question? All of the question is, for example, you are an owner. That means you have traditional IRA, right? And when you are required to begin receiving the distribution,
So
when you are
option 4 and
four,
yeah, and not option 1, because sir, option 1 means we have attained the age of 72, and it means in the next year following the this I have attained the age of 72, and suppose it's the December month going on, and the April month is after 3 months. So sorry. So the rule we studied, as soon as we attain the age of 72, we have to start receiving the distributions.
How about others? So the first option is by April 1 for the year following the year in which owner reaches 72 years. That means if in 2021 you are reaching the age of 72, then from 1st April 2023 will start receiving. That's the first option. And the fourth option is by April 1 of the year in which owner reaches 72. That means 1st April 2022.
Option first.
Why?
Because 72 and a half is the limit.
Okay. How about others? Mayank, Garima?
So like if first one is the answer, considering the 72.5, 72 and a half. So what's the difference between the first and the fourth one?
So first one, it's saying by April 1 of the year following the year in which owner reaches 72 years. That means in financial, like for example, my date of birth is October, right? I'm getting 72 in October 2022. So first point says you'll start getting it from 1st April 2023. Whereas fourth option says 1st April 2022. In the year the owner reaches age 72. So that is the difference between first and fourth.
So I am confused between first option and the last option.
What is the confusion, Garima? What exactly is the confusion? Have you not understood the option, or you are still evaluating, like trying to remember?
So I am just evaluating, right?
But what's coming in your mind? You know, why 1 or why 4? Why not second or third?
Because the age limit that was mentioned, it is like 72, and the fourth option is saying that by April 1, like of that financial year, in which the owner is reaching the age of 72, and in the first option, like I'm just confused in both of the options.
Why not second and why not third? Why not second or why not third? No one is in favor of second and third. It's only first and fourth. That's what you're presuming. Got it. So if you remember, the taxpayer is not permitted to keep the funds in a traditional IRA infinitely. Eventually, they must be distributed. For a tax year 2021, the owner of the traditional IRA must start receiving the distribution from his or her IRA by April 1st of the following year, in which he or she reaches the age of 72. So the amount must be distributed each year is referred to as the required minimum distribution. For the tax year beginning after 2019, the age of the required beginning date for mandatory distribution is changed for the taxpayer reaching age 70 and a half year after December 31st, 2029 to age 72. So this is new update in the tax law. Earlier it was 70 and a half year, but now it is 72 year. So it means to say the year in which you are reaching 72, following that year, that means next year, 1st April onward, you need to start getting the minimum distribution. Make sense? Mayank, Shubham,
Yes, sir.
Yes, sir.
Sachin, got it?
Yes, sir.
Last question. Diana, single and age 49, made a $4,000 contribution to her traditional IRA in 2021. Her compensation for 21 was $3,000. She filed a form 4868 for an extension till October 15, 2022 to file her 21 return. In order to avoid 6% additional tax on excess contribution, Diana must do which of the following? Here, if you see, she is earning 3,000, but she is contributing 4,000. So her contribution is more than her earning. So to avoid any additional tax, what she do? First one is withdraw the 1,000 excess contribution and all interest earned on $1,000 by April 15, 2022. Second, withdraw 1,000 excess contribution and all interest earned on $1,000 by December 21. Withdraw 1,000 excess contribution and all interest earned on 1,000 by October 15. File an election to deduct 1,000 on her 22 return by attaching a statement of her 2021. So what should she do? Have you understood the question? You guys understood the question?
Yes, sir. So please scroll a bit, sir. Just scroll a bit, sir. I want to look at the questions.
Say that again. Which limit?
Sir, I want to see the question, sir. Yes. Oh.
Yes. Sachin, Vivek, Shubham, Garima. What is the call of the question? What is the call of the question, guys? What is the call of the question? Are you here?
Yes, sir.
What is the call of the question? Like she earned $3,000, but she has contributed $4,000. So she has contributed more than her earnings. Right? If you are contributing more than your earning, then there's a 6% additional tax which you need to pay on the excess amount which you have contributed. Right? What should Dinah do to avoid the tax, additional tax liability?
Sir, I think option 1, because even though Dinah has filed she is opting to file the extension. सर अगर जो एक्सटेंशन फाइल करना चाह रही है तो आई थिंक जो हमारी नॉर्मल टैक्स की डेडलाइन रहती है बाय 15th of April, उससे पहले तो आई थिंक जो उन्होंने एक्सेस कंट्रीब्यूशन करा है वो विड्रॉ करना पड़ेगा, नहीं तो जो सर टैक्स की जो स्लैब होती है आई थिंक उसमें आई थिंक वो उनके वेजेस और समथिंग आई थिंक
or can she go with the fourth option?
सर फिर तो December 31st 2022 होगा ना एक तरह से फोर्थ वन। सर लास्ट वन फिर मतलब लाइक इट इज December 2022।
No, like in the when she is filing her income tax return, in that she can make a statement that additional contribution to be considered for next year.
Okay.
Can she do that?
फोर्थ ऑप्शन लग रहा है
Sir, yes, she can definitely do that. But sir, if what will she mention in that, like in her IRA? The probability goes for the fourth one only. For the first one is also right, but by April 15 it is said. So
Second one, it's saying by December.
so second is 2021. Sir. So sir.
So like file her 2021 return, no?
Yes, sir.
So it's about 21 return which she need to file by April 15 of 2022.
40 की आएगी ना 40 या 50 65 की दवाई क्या लगता है
Sir, go with the first and fourth one, sir.
Okay, let's see. Sorry, that's incorrect. By October is the right option. So provide the general rule for the tax when making excess contribution to IRA. In general, the taxpayer is subject to 6% of tax in excess contribution for the year are not withdrawn by the date the taxpayer return for the year is due. So that is like October 15, 2022, because she has filed an extension also.
ये अक्टूबर वाला ठीक है क्या
Yes, because including extension date. Till that time, she can withdraw.
Okay.
Not so good, but no worries. We'll figure it out soon. Let's jump back to the notes. So distribution of IRA, we can add two things here in the notes. Cool. Okay, let's continue with our notes. Yeah, so we covered till here, I think. Yeah. So before we went on a break, and before this question, we covered this limits, maximum contribution. We covered earned income, deductions, all these things we have covered. Non-deductible IRA also we have covered, and Roth IRA, and qualified distribution details also I think we have covered. Right? Roth IRA also we have covered, right? Before we went on a break.
Yes, sir.
Right. Okay. So now we need to start with simple. So there are a few other plans also. Let's finish off those and then we jump into the main topic, which is rollover. First one is simple retirement plan for small businesses. Small businesses are those businesses in which you have less than 100 employees. So the simple full form of simple is saving incentive match plan for the employee. That in short we call simple retirement plan. So simple retirement plan, employee maximum contribution is 13,500 compared to 6,000 or 7,000, which we have in IRAs, right? In a simple plan, the employee can make more contribution. How much? 13,500. And if the employee is more than 50-year age, then additional contribution he or she can make of 6,500. That means total limit of simple retirement plan is $20,000. 13,500 plus 6,500 if the individual is more than 50 years of age. If an employee participate in any other employer plan during the year, then maximum total contribution of all plans. For example, I am an employee, right? I am doing my self contribution to simple retirement plan, and my employer is also deducting, and I have multiple jobs and 2 or 3 of my employer are also participating in the retirement plan. So altogether, putting all together, the maximum limit is 19,500. So I cannot make annual contribution more than 19,500. If I make more, then 6% is the interest or penalty I need to pay. But if I'm age more than 50 year, then maximum contribution to all I can make up to $26,000. 19,500 plus 6,500 for age more than 50 years. Make sense? In the simple retirement plan, what you can do, maximum contribution 13,500 or total contribution including all kind of retirement plan should be 19,500, right? How this 19,500 are coming? 13,500 plus 6,000 for IRA. So that is 19,500. But if you are age more than 50, then you can do simple retirement plan contribution of additional 6,500. Same is the case of total contribution. You can add more 6,500. That is $26,000. Now coming to distribution before the age of 59.5 years. Is subject. Yes, please.
Sir, इसमें सर इतनी contribution इतना ज़्यादा allowed क्यों है? Like we compared it to the traditional or the Roth IRA.
Yeah, so very good point. Like to the best of my understanding, I may be wrong or my understanding may be limited. This traditional IRA or Roth IRA generally more structured and big company they use. They want to protect the retirement plans of the employees or the worker who are working in small and medium-sized companies, which have like less than 100 employees. So they have given an opportunity for them to do more contributions so that in future they will get more pensions. So their future will be more secure. And their salaries are comparative to big MNCs are less. So generally like overall total contribution they can make is less. So that's, to the best of my limited understanding. But yeah, I can do more research and come back to you.
And one more thing, sir, ये जो contribution that is for 1 year, yeah?
Yes, annual contribution. Yes.
And so जैसे हम जो treatment बाद में करेंगे वो like the same way itemized the deduction की तरह ही करेंगे, है ना?
Yes.
Thank you.
And now the distribution part. If you are withdrawing the money from the IRA or from the simple plan before 59.5 years of age, right? Then there is a 10% penalty on the amount you have withdrawn. Except for in case of death, for example, the client got died and now the legal hirer of the client is withdrawing, then it's not taxable in the hand of legal hirer, right? In case of disability, like the client has met with any accident and he is disabled, and now for his or her survival, he wants to withdraw a certain amount, then that is also not taxable. For any medical expenses, for any health insurance of unemployed individual, right? For employed individual, employer will take care, but for unemployed, if he or she wants to take care of his or her health insurance, for that also like individual can withdraw. qualified higher education expense if the individual wants to do any further education or higher education, to the extent amount is being withdrawn for tuition fees, book, supplies, equipments, room rent, boarding. So all those things will be allowed. No additional penalty will be levied, right? Either it for self or for the spouse or for the dependent children or dependent grandchildren also. Next one is first time home buyer. If you are purchasing a new home, maximum up to $10,000 you can withdraw without any penalty. If you are adopting any child, right, or if there is a birth of any child, up to $5,000 for individual, and married filing jointly up to $10,000 can be withdrawn without any penalty. And COVID impact, it in the Finance Act 2020, CARES Act 2020, they have given a limit up to $100,000 that is being initially allowed for January 1st, 2020 to December 31st, 2020. That has been further extended for one more year. So the limit is same till December 2021. Right? These all distribution or withdrawal are allowed. So if any of you or any of your client is withdrawing for these reasons, then there is no interest or penalty. If for any other reason, any of your client is withdrawing before 59.5 years of age, then there is a 10% penalty. Make sense? Got it, everyone?
Yes.
Sachin, Vivek, Mayank.
Yes. Yes.
Cool. Okay, so other retirement rules. Other retirement rules, self-employed person may deduct up to $57,000 in 2021 for contribution to a qualified retirement plan. So far, we were discussing all from the employee perspective. Now, from the self-employment, which is your sole proprietorship, partnership, LLP, LLC, or maybe your S corporation, which is a pass-through entity. In that case of scenario, the person who is like partner, owner, sole proprietor can make up to $57,000 contribution to the specified retirement plan that is called 𝐂𝐽 plan. Right. Next is simplified employee pension, SEP. This is also another plan. Second. So in SIP, IRA have similar limits and have replaced the 𝐂𝐽 plan among all but high-income professional who established 𝐂𝐽 plans over the decade. So similar to 𝐂𝐽 plan, the simplified employee pension plan is also have same limit of $57,000, maximum contribution $57,000, and maximum deduction is lesser of 25% of earned income or contribution, whichever is lower. So now another thing is IRA distribution. So first is type of distribution, and distribution include principal amount and earnings. Earnings mean interest or dividend, right? So for example, every month you are contributing $500. That means every year you are contributing $6,000. And let's assume you have contributed for a period of 10 years. That means $60,000 you have contributed in any plan. So $60,000 is your principal amount which you have contributed. But over the period of 10 years, basis on your contribution, there would be some interest or dividend which you have earned and cumulative invested. Right? How to make a treatment of the principal amount and how to treat the earnings on the principal amount over the period of time. First one is when you have non-deductible traditional IRA. What is non-deductible traditional IRA? What is non-deductible traditional IRA? What is non-deductible traditional IRA, guys?
So we do not take it as the itemized deduction, but over the period of time when at the time of retirement, we have to pay the taxes on the interest and the dividend.
No, partly right, partly wrong. So non-deductible mean today it is part of your income and you are not considering it as itemized deduction. That means you are paying taxes today, right? So the contribution which you are making, you are depositing in the IRA, that is from your taxable income. You're not getting any tax benefit. So on that amount, you have already paid tax. So in future, when you are withdrawing the principal, it should be non-taxable, isn't it? Right? There should not be double tax. For example, your income for, let's say, 2010 was, let's assume, $100,000, and you have contributed $5,000 into the IRA, which is non-deductible. That means you have paid taxes on entire $100,000 at that point of time, right? Yes, no?
Yes, sir.
Now you are retiring and you are withdrawing that money. So the principal was net of tax. That means you have already paid the taxes, right? Should not be taxed again, right? Make sense?
Yes.
Yes.
So
But the
if
interest should be taxed.
yes, so if you see the first column, the principal is non-taxable, whereas the earnings on the same will be taxable. Make sense?
Yes.
Second is deductible traditional IRA. What is deductible traditional IRA? What is deductible traditional IRA? I think we discussed at length before we went on a break. Come on, guys.
So to reach at AGI, we deducted from the gross income, the itemized, as a part of the itemized deductions.
Sorry, say that again.
So to reach at AGI, we take the like our contribution to the IRA as a part of the itemized deductions and subtract gross income.
Okay. So for example, if in 2010 your income was $100,000 and you have deposited 5,000 into deductible IRA, that means that 5,000 you have reduced from your gross income to reach a taxable income, right? You have taken a benefit of tax at that time when you have made the contribution. Yes? Yes? No?
Yes, yes, sir.
Mayank? Sachin?
Sir.
Vivek?
So like I'm just read about the non-deductible traditional IRA, non-deductible. So from the notes, and I got to know that as the money we contribute to traditional IRA, and it is those amount which we do not deduct on our tax return.
First point for non-deductible.
Yes, so like for it is for the non-deductible. So what like someone just told that amount we get of the amount we convert into AGI is deductible. So is there like any theoretical information like
No, simple. For example, for 2010, and let's assume this plus one. So let's assume in this 5 years, this is your income. So your income is, let's assume, $100,000, and every year you're getting 10% increment. So let's assume this is your income. And here you have deposited in deductible IRA. So deductible IRA, out of this 1 lakh, out of this $100,000, you have deposited 5,000. So that is deductible. That means you'll be reducing 5,000, right? So what is your taxable income?
95 in the first one, and
so this will be your taxable income.
yes, sir.
Yes, no, right?
Mm.
So if same is the scenario, if I'll keep it separately. So in this scenario, if you see your taxable income is going down, right? So that means you are paying less taxes. Let's say tax rate at the rate of 20%. So this multiply by 20%, that's your taxes, right? Mayank,
Yes, sir.
Garima, everyone getting my point? So if this is non-deductible, in that case of scenario, you might not be deducting anything, right? And you might be paying taxes on this. So if you see here, you will be paying less taxes, right? So here, if you see, you have paid $1,000 less tax year over year, right, Mayank?
Yes, sir.
Huh? So if you have paid less tax in the year of contribution, so when you withdraw that money, so will it be taxable or not? That's
So I have paid less contribution.
the same thing. Like if you remember this example also we have discussed, like based on the same. This is the same example I'm just saying. Like if it is deductible, that means you have paid less taxes in earlier year. So now if you are withdrawing, then you need to pay taxes. Make sense or not? Yeah, Mayank. Mayank, can you hear me?
Yeah, yes, sir. Sorry, sir. There was a issue, sir.
So what I'm saying, if you see the first example, so earlier year you have paid less taxes.
Yes, sir.
Right? So now if you're withdrawing, you need to pay taxes on that.
Yes, sir. Yes, sir.
Right? That is what is mentioned over here for non-deductible. So when you are withdrawing, your contribution or your principal is taxable, as well as the earnings you have made, that is also taxable. When in the earlier year, it was non-deductible. That means you have already paid more tax. How much more? 1,000 every year you paid more, right?
Yes.
So now if you are withdrawing, then that principal should not be taxable.
Yes, it should.
Sorry, non-deductible. So principal contribution will be taxable, and here it will be non-taxable. Sorry, my bad. So here your deductible, which you are receiving back, should be non-taxable because you already paid taxes on that in earlier year. Only the earnings will be taxable.
Yes, sir.
And Roth IRA is always principal non-taxable, and earning is also non-taxable at the time of withdrawal. And for non-qualified Roth IRA, principal is non-taxable because you already paid taxes, but earnings are taxable. Right? Sachin, yes. Vivek, Divya, any doubt here?
No, sir.
Yes, sir.
Okay, sir. Okay, complete.
Okay, so distribution from Roth IRA are considered to first come from principal contribution. On this too we have already discussed. So now coming to the rollover and conversion of retirement plan. So what is rollover or conversion? Rollover means you are changing from one plan to another plan. You are converting your investment from one plan to another plan is called rollover. So first option here is rollover from traditional IRA to Roth IRA, right? In the traditional IRA, there are two categories of IRA. Yes, no?
Yes, sir.
So what are the two categories of IRA?
Non-deductible, deductible.
Deductible and non-deductible, right? Right, Sachin?
Yes, sir. Yes.
So any transfer from deductible IRA to Roth IRA to be included in the income at the time of rollover or transfer with no 10% early withdrawal penalty. For example, so if I take you here to this Excel sheet, let's build an example. Let's build an example over here. So for example, in the 2010, 2020 and 2021. So here you have traditional IRA, which is deductible. So let's assume you have a balance of, let's assume $50,000, which in 2021 you want to convert from traditional IRA to Roth IRA. What is Roth IRA? What is Roth IRA? Guys, please.
Everybody sleeping.
It's a kind of non-deductible. But also the interest is not taxable.
I think it is not eligible to deduct tax on tax.
So when you have traditional IRA, which is deductible, that means you are reducing every year from your income. Whereas Roth IRA is always non-deductible, right? So on this $50,000, which you have deposited, let's assume $5,000 each year. So you have taken a benefit of tax in the last 10 years over this $50,000. Make sense?
Yes, sir.
Make sense, Sachin?
Yes, sir. Yes, sir.
So now you are converting that deductible to non-deductible, right? So for non-deductible, what are the future benefits? That means your principal is not taxable as well as earnings is not taxable in future, right? But here, when you are making a contribution, you need to make them taxable. So here in 2021, when you are doing conversion, at that point of time, you need to consider this 50,000 as your income and you need to pay tax in that year. Make sense, Sachin? Mayank?
Yes, sir.
So that's what, if you go back here in your notes, it says any transfer from deductible IRA to Roth IRA to be included in income. That means in the financial year 2021, this will go into income and need to be tax on this. Why it will go to the income? Because in earlier year, you have a reduction. You have taken a benefit of deduction. But now you are converting. So as you are converting, you need to pay taxes. But good thing is that if you are doing a conversion, then there is no penalty of early withdrawal. Make sense? Vivek, Sachin, Mayank?
Yes.
Sir, I have a question like, sir, जैसे एग्जांपल कोट करा अभी 2020 में 50,000 का हमारा कैपिटल जैसे हो गया था, तो 2021 में हम कन्वर्ट कर रहे हैं जैसे Roth तो सर 2021 में मान के चलो सर हमारी इनकम 200,000 है और ये 250 पे हो जाएगी सर इनकम।
यस।
तो सर ये टैक्स का वो नहीं होगा सर, जैसे कि टैक्स की लायबिलिटी की लाइक ऐप के अकॉर्डिंगली से मैं पूछना चाह रहा हूँ कि टैक्स लैब।
Yes, you need to pay more taxes. Yes.
More taxes है इसके ऊपर, है ना?
Yes, absolutely true. But in future, this principal and the earning on this principal would be exempt.
Okay, sir.
Because now it is converting, it's changing over from traditional to Roth IRA. And as per Roth IRA, withdrawal of principal and the earning on the principal is non-taxable. Right? So next line is withdrawal allowable to the amount transfer from traditional IRA cannot be made until those amount have been a Roth IRA for 5 years. So 5 years is a lock-in period, right? If you are doing early distribution, then there is a penalty of 10%, except those qualifying reason, right? Which is like medical expense, health insurance, qualified higher education, or first-time home purchase. Roth IRA are best when you think your taxes will be higher in the retirement than they are right now. So traditional IRA deductible is good when you think in future your earning will be less. But when you think in future your earning will be more, then Roth IRA is a good option to purchase. Right? I think we should take a break over here. People are feeling overwhelmed or drowsy, I'm not sure. Shall I take a pause over